Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Apple stock. It was recently in the news again. I mean, it's always in the news, but Mark Zuckerberg had some things to say about them, about the company recently. I also have somebody in the comments section talk about their buybacks and what I thought of those. So I thought I would revisit Apple. I've talked about it a couple times on the channel and show you why I think it's really risky right now. Maybe riskier than any other time that I can think of to own it. As always, this is not individual investing advice. It's just how I analyze stocks. So, excuse me. The way that I'm going to go about doing this analysis is to see how long it would take an investor to earn their money back just from Apple's earnings. So it would be like if you bought the whole company yourself for, I usually use $100 as my example, as the metric that I use. How long would it take to earn $100 if you owned the business, right? So that helps give people, I think, an idea of the valuation. It's a different way to look at the valuation in terms of a time frame, and you can compare it to other things that you could try to earn your money back with, like bonds or a rental property or anything else like that. So it can be useful that way, but there's also risk that comes with time too. So the longer it takes to earn your initial investment back, the bigger the risk is that something will go wrong and you won't be able to earn your investment money back, that you could lose money, unlike, like a government bond or something. So let's get into that. I call this a time until payback analysis. I've done a few of them on the channel. Usually, sometimes I do it with dividends. This time I'm going to do it with earnings. And then I plan on doing more of these videos in the future because I think they're really useful. So let's start on the fast graph here. Well, actually, let's go back and just look at the history. So we know we have a high quality business. I mean, everybody knows Apple. The iPhone came out somewhere around here. And since then, the stock price is up about 3,500%. So the growth of, did they have the 10? Sometimes they put the growth of $10,000 in here or something. Maybe that's it. I'm not sure. But you would have done well if you bought Apple stock way back then and you held through today. I actually owned Apple stock in my daughter's account from, I think it was about mid 2013, right around July, if I remember correctly, until the beginning of 2020 in January. So I'm not an Apple hater. We actually had like a 500% return with the dividends. So I like Apple. I own a ton of Apple products, which I actually bought most of them during the COVID boom when I was kind of upgrading all my equipment like everybody else. And I'll talk about that in a minute. So I like Apple the business. I've done well with the stock in the past, but it's just really overvalued. And so I'm going to try to show you guys why. And why it might not be exactly obvious at first. Okay, so now let's get to this 10-year time frame that we have before us. If we look at the earnings growth on the fast graph, we have a 12% earnings growth rate from 2016. So this is a 10-year period, and it's looking forward to this year, like through September, which is actually they're expecting 21% earnings growth. That seems high to me, but we'll see what happens, okay? We also have the stock just coming off its all-time high at the end of the year, basically, right? So it's down a little bit. I think that might end up being the all-time high, but we'll see. There is a scenario or two where they don't do poorly, but the stock doesn't do poorly. But I don't think it's going to be have the best odds. So we have a 12% growth rate just on the top, earnings per share growth rate. We have a 35 PE. So if we just take that, that's a PEG ratio of about 3. So that's already, just looking at it right there, pretty much you should think about selling or trimming a stock that's kind of in that range. And that's assuming that they get this earnings growth rate this year, okay? Which they might not. So now let's kind of pick this apart a little bit more. So there's kind of two main things, maybe three, that I would point out here. Other than a big tax cut year, like in 2018, which earnings grew almost 30%, and the huge COVID stimulus that came about in the second half of 2020 through 2021, and that was mostly gobbled up by Apple and Google and Microsoft, like a handful of companies. I mean, other companies did too, but I mean, these guys did extremely well. So we can explain these as kind of one-time events. Now, the debate in the U.S. Congress in the next several months is going to be whether to extend these tax cuts. So there could be a little bit more tax cuts, like corporate tax cuts, but it might be difficult just to get the tax cuts that were there extended so they don't reverse, right? For individuals. Now, the business ones, I think they made permanent, so that would probably affect Apple more, but if Apple's customers have to pay more in taxes, maybe they don't have as much money to buy a new phone or they wait a next year or something. So for the overall economy. So if you exclude these 2 years, earnings growth is much lower. Now, the other issue is that these earnings growth rates are based on earnings per share in the fast graph. So, and Apple has bought back a ton of stock over the past 10 years. This is just exactly 10 years. They bought back 35% of the company, basically, with share buybacks. So what this does is it actually inflates these earnings per share numbers because the number of shares have been reduced. So their actual earnings growth has not been 12.5% or so. Once you control for the shares outstanding increase, the actual earnings growth with the method I use has been about 7.5% per year over the past 10 years. So that's significantly lower, and that's because they bought back so many shares. I would add that those share buybacks worked out extremely well for them because they were doing them back actually before this. And then they got this big one-time boost, and then they kept buying back more shares, and then they got another big one-time boost. And so what those share reductions do is they amplify that earnings growth even more and the earnings per share because they reduced the shares before they got the earnings boost, right? So it kind of amplifies all that. Which all that is great if you owned Apple stock like during this time because the stock has done well. I would say it's done well up until kind of up until 2022. And then we can see earnings have been flat. The stock is up a little bit since then, but I think this is just kind of a goofy bounce, honestly. Yeah, it's up like 25%, but that's like what, 12% a year, 10% a year because it's been 3 years now. So less than that, yeah. So even the stock price isn't up like a ton in the past 3 years. It probably doesn't deserve to even be up that much, honestly, but most of this growth came from the COVID stimulus, and that's pretty obvious, I think, by looking at it, but I'm trying to show how these earnings aren't as good or aren't as likely to be good going forward, okay? If we're using the past, like I do, to usually kind of get a guide for the future, you always have to understand like what's going on to push you want to be aware if there's certain things like this that are artificially kind of keeping or are temporary that won't happen again, right? Is what I'm trying to say. So with all these things in mind, it's important because we want to establish what our earnings growth rate is going to be for the future, what our expectation is for the future. And we'll have a much lower number if we adjust for the share buybacks, if we adjust for the one-time tax cuts or stimulus, right? If those don't happen again, so if you adjust for those two things and you adjust for inflation, they've had no earnings growth for 10 years. So that's a fully mature company. Now, the good thing is they kind of dominate. They found other little ways to win with services, with other new products like AirPods and things like that. That's all great. But they're really kind of just maintaining their level that they reached, 10 years ago or so. Which maintaining is better than falling, right? But the question is, should we expect 12% earnings growth? the market's actually pricing in something like if you legitimately take this like 35 PE, I mean, you really need 20% earnings growth to justify that. And they're going to probably have like mid single digits or something. Okay. So they're like, unless they come out with like new products, the VR headset doesn't seem to be doing great as far as I can tell. So unless they come out with something new, which is as Zuckerberg pointed out, they haven't really done too much. I mean, they charge people a lot of money for the App Store, which is they just have a lot of places that they can lose, more places that they can lose going forward than win. I think maybe if relations with China improve, that could be an area, and the economy in China improves at the same time, that could be a big area of growth for them if that turns around. But I would say owning Apple stock here that's probably the big bet that a person's going to make. That's the bet they're making, unless some big new product comes along. So with that set up, we can get into the math. What else did I have here? Oh yeah, so I have 10-year revenue. Okay, so that's up 84%. You can see that because this isn't going to be influenced by the share buyback, so it's a little cleaner, right? So revenue over the past 10 years has grown 84%. That's like a 6.5 CAGR, give or take. So that's half what it appears in the fast graph. Okay, what the earnings per share earnings CAGR would be. So I think this gives a much clearer. And again, mine was 7.5, so it's pretty much right in line with this, with what the revenues have done. So it just kind of giving more evidence to my method here. So this is the revenue growth over the past 3 years. Total, it's grown less than 7%. I mean, this is like 2% revenue growth per year, and the last 2 years have been negative, basically. I mean, maybe flat. Maybe you call that flat. I would call that negative. So revenues aren't going anywhere right now. Inflation adjusted, this is negative, right? So that's also kind of leaning toward the no growth thesis, right? And when you put that on top of a 35 PE, it's just like a recipe for poor returns. There's probably a lot of people with gains in Apple that don't want to sell them for capital gains reasons, so it could take a long time for the stock price to fall. Sometimes that's even worse because people don't realize how poorly they're doing until it's 5 or 10 years down the road, and then they look back and they realize it's like AT&T or whatever. They realize they made no money for 20 years or something. That could happen too. It might not just fall like off a cliff. Okay, so let's get to the actual valuation. So what we want to know is if we bought Apple, the business, for like $100, how long would it take to earn $100? And to do that, you take the earnings yield, and you need the earnings yield and the earnings growth, and then you can extrapolate that out and figure out how long it would take to do that. So that's what I do here in my spreadsheet. The earnings yield, which is just the PE ratio inverted, the earnings over the price divided by the price. This is using those forward earnings of $7.38, which is expecting 20% growth this year. So I think this is probably optimistic, is 3.21%. So if you bought Apple for $100, it would earn $3.21 the first year. Now, my generic earnings growth rate that I've been using for the past several years for Apple has been 10%. Just because I figured they'll come up with some new service or something to maybe grow, and we'll have inflation, and you put all that together. And I try to give them the benefit of the doubt because, they're a huge company. They have a lot of resources. They could potentially come up with something new. And so my real earnings growth rate, if I just calculate it like normal, is 7.49%. So I'm being generous. I'm adding like 30% to that basically. So I'm going to assume they can grow earnings at 10% after this 20% growth year, okay? And I pull forward the first year of growth. So let's scroll over to the right here. And let's see. So the first year, that's the rate. The first year we would earn $3 $3.53 on our $100, and the next year we'd earn $3.88, and the next year we'd earn $4.27, and then we would accumulate this if we just kept the money for ourselves, right? You own the business, you keep the money. I want to see how long it would take for all this money to add up to $100. And it would do that in year 15. So it would take you 15 years if you buy Apple today, that's right here, to earn your money back from the earnings of the business if earnings grow 10% a year, which I think is pretty generous. I mean, now we could have inflation, and Apple can definitely pass inflation on. So one of the benefits of owning it compared to like a bond or maybe compared to something else is, they're a high quality business that can pass the cost of inflation on. So if inflation is 5% a year, then you would rather own Apple than cash or something probably, right? Because maybe then they can grow 10% or get a bonus. Or, the government puts more money in. There's scenarios where it could happen, or you could earn more than that. But I really think I've been pretty generous here, and it still would take 15 years to earn your money back with Apple stock. This is actually about where the S&P 500 is right now. So Apple isn't technically, if you assume they can grow earnings 10% a year for the next 15 years, in that respect, it isn't any more overvalued than the S&P 500 because the S&P 500 is overvalued too. But like 12 years is pretty good. 10 years is like maybe you're consider buying the stock. Like that's on the cheaper end given where interest rates and growth and everything has been lately, just to put it in perspective. So it'd be like 50% more than when I'd buy it, and maybe like 35% higher than like fair value. I'm just trying to put some actual numbers on here other than just the years. Now, the problem is it not only is this valuation high, but there's a lot of risk, right? Things in China could get worse. I would say there's a above average likelihood that happens. They might not grow earnings 10%, right? They could have competition from other things like AI, and people have, products that utilize that better. And so they could have regulations when it comes to like their app store and things like that, which we've seen. There's just a lot of issues that could happen. We could have a recession, right? And so far, a lot of Apple's customers have been spared because usually they make a little bit more money than the average person. But if there's a recession, that damage is kind of going to work its way up the income and wealth scale, and it will hurt Apple. Apple hasn't had a recession since they invented the iPhone, right? So we don't really know what kind of issues could come up during a recession. If people are like, hey, I'm going to wait 2 or 3 more years before I upgrade my phone or, subscribe to that service or whatever. So all those risks are out there. This assumes none of them. And if none of those risks happen, then you earn your money back in like 15 years. So that's my message on Apple. I just think it's just overvalued right now and pretty risky. And it has risks that I think some other stocks don't have, like even like a Alphabet. I don't own Alphabet right now. If I had a choice between Alphabet and Apple, I would take Alphabet way over Apple. They have lots more potential upsides, much fewer downside risks given the risks that are in the economy right now. So yeah, that's if you want to have like a mega cap weighting still, I would move from Apple to Alphabet and call it a day. Okay, thanks for watching. I have weekly picks over on Patreon for $25 a month. I have a free tier on Patreon. Those links are down in the description. And I will see everybody later.